So accrued revenue, in this case, the first instance is when you earn the revenue but you haven't received it yet. So that is the balance day adjustment. Common circumstances when that happens is when you earn interest on term deposits but not yet received the cash. For example, you have a term deposit, it's 12 months, 6 months goes by, you have a balance day, you've earned 6 months revenue, but you don't get paid to the end of the term deposit. So that's what causes this. You've earned the revenue, but you haven't received it yet. It's a balance day adjustment. So what journal will it go into? The general journal. The entries are always the same. In this case, we have created a new account called accrued revenue. And when I explained it the other day, remember I said pairs are assets, prepaid expense, accrued revenue. Accrued revenue is an asset. I'll give you some notes on that in a second. It's an asset because there's future benefit. What's the future benefit? You're going to get the cash in the future. Okay? So debit the accrued revenue, credit the revenue because you've actually earned it. So in this instance, the balance day adjustment happens first. So accrued revenue is what account classification? It's a current asset because usually that benefit will come within 12 months that your phone's away. There's future economic benefit, and as you just told me, it's going to be cash in the future. What's the second part of the definition? What's the 3 parts of an asset? Future economic benefit, result of a earning that revenue is your past transaction. What's the last part?
12 months.
12 months is the current part. What's the last part of an asset? Controlled by the entity.
How do you link that?
Yeah. Controlled by the entity is the right to expect the benefit. For example, when you've got a term deposit, you've got a relationship with the bank. The bank has given you the power to have that term deposit. You're in control of expecting the revenue that flows from that. Is that too far up?
No.
We're all good? I'll just pause it to give you time to write. The other thing they often ask you questions about is the effect on the accounting reports. So, there's always the 3 accounting reports we have to refer to. First one, statement of cash flow. How does that balance day adjustment affect the statement of cash flow? It doesn't because it's in a general journal. No effect. The effect of accounting reports. A/C is short for accounting. A/C is short for account. Income statement. That balance day adjustment, does it affect the income statement? Yes, it does. How?
Revenue.
Increases revenue, therefore increases profit. therefore.
Is it actually? Yeah. See it all the time.
Yeah, they do it now.
Size and
Balance sheet. Bingo. First of all, assets. What does it do to assets? Increase it. What does it do to liabilities? No effect. There was no mention of liabilities in that general journal entry. And what does it do to owner's equity? Increase it because profits increase.
It's right.
So that's the first stage. So, first instance was balance day adjustment. The second instance that we have to deal with this accrued revenue is when you receive the cash from an accrued revenue. It usually occurs in subsequent periods. Now, this theory that I'm going to do for you now is exactly the same theory that I did it when I taught you accrued expenses. And you mucked it up a lot, and even in the exam. So just always do it the same, and you can't go wrong. Okay. Draw yourselves up a cash payments journal, please. Blah, 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 blah.
Payments journal.
Receipts. Sorry.
Alright, out for this.
My God.
Now, the rule is exactly the same as when I taught it with the accrued expense. When you receive cash, you may receive cash just for the revenue from the previous period, or you might receive cash that's part accrued revenue and some actual revenue. So the rule is the same as what I taught you last semester. Always put in the cash received for the accrued amount first. So in this case, I'm giving an example where they're going to get $1,000, 900 of it's accrued, 100 of it's current. So accrued revenue, it's probably going to be an electronic transfer, so if it's got a receipt number, put 1 or do EFT, have something there to show that it's the money's gone in. So this is a receipt of cash for an asset. So you're basically moving it from one asset to another. Accrued revenue goes down, cash at bank goes up. In the same transaction though, sometimes some of that revenue is current. That has to be recorded separately because it's revenue. This one up here is an asset. This one here is a revenue. So that's why we have to have two separate numbers. Interest revenue. Okay? So the rule always is one number, pay or receive the money for the accrued first, and whatever's left over is a current revenue. Okay? The rule's always the same. So, if we've received cash, let's look at the effect on the accounting reports. Now, in this example, I'm going to show with numbers the effect with both of them in there, just in case it has both in there. So be aware that it's including both numbers dealing with it. First of all, statement of cash flow. Is there an effect?
Yes.
Yes, there has to be because it's got in our cash receipts journal. Is it an inflow or an outflow? Inflow. Operating, investing or financing?
Operating.
Done.
What do you call it? Like in
Accrued revenue, interest revenue. Interest received is fine.
Oh.
banking employees.
Correct. I should say the number. So you can report them as interest received as one number, or as accrued revenue, interest revenues, two numbers. The total amount for operating inflows would be $1,000. In the income statement, I'm only dealing with if revenue has been affected. Has it? Yes. Has it increased or decreased? Increased. Interest revenue would show up where on the income statement? As other revenue. Now, the important thing is only the revenue value is the value that changes. It's only $100 good, because that is the only part that's revenue. The other one changes an asset.
Now we're going to do the BS.
Lastly, let's look at the balance sheet. The assets section has the most that changes. Okay? Because if you think about it, what's going to happen to your cash? It's going to increase by how much? How much is your cash going to increase by? $1,000, the total amount. You had accrued revenue, but now they had given you the cash for it. So is it still accrued? No. So it's going to increase or decrease accrued revenue? Decrease it by how much?
$900.
$900. So what's the overall effect on assets? It's an overall effect of an increase of 100. What's the effect on liabilities from this transaction? No effect. There's no mention of liabilities there. What's the effect of the owner's equity? It increases. Why? Because profits increase. Because if revenue increases, therefore our profit increases. How much is it increasing by? $100. Can you see how that keeps things in balance? Increase 100, increase 100. We're all balanced. Does that make sense? Okay. We're now going to do exercise 16.6 together, please. 16.6.